Good morning. Thank you for joining us today. I'm Andrea Thermos, a partner in Boulet's Estate and Trust Department. To start with, I have a few housekeeping items. If you have questions while we are presenting, please type them in the Q&A feature at the bottom of your screen. We will be answering those questions at the end of our presentation. If the questions go long, we will stay on to answer them, but please feel free to leave if you have another engagement to get to. The session is being recorded and a link will be sent out to each of you in the next couple of days. Our third session in the Anatomy of a Trust series will be on June 7th, covering charitable trusts. As I mentioned, I'm Andrea Thermos, a partner in the Estate and Trust Tax Department here at Boulet. I joined Boulet about 10 years ago, and was promoted to partner last June. I have over 20 years of experience in the estate and trust world, with my primary focus on tax compliance and planning as it relates to estate trusts and gifts. I serve on the MNCPA task force for the Estate and Personal Financial Planning Conference. In my free time, I love to experiment with new recipes and entertain friends and family. Today, I'm being joined by Emily Blackburn. Emily is a senior manager in our Estate and Trust Department, and she joined Boulet in 2013. She also specializes in estate trust and gift tax compliance, along with comprehensive estate plans, probate and estate administration, including asset management and trust funding. She draws from her education in both accounting and law to be able to provide a variety of services for her clients. In her free time, she enjoys all types of outdoor activities with her family and friends, sampling all the desserts she can and chasing after her daughter, Winnie. In Boulet's Estate and Trust Department, we assist clients in all stages of life. Through our holistic approach to estate and trust planning, we take into consideration the different objectives you have throughout your life when it comes to retirement planning, charitable giving, and caring for loved ones. We strive to develop an estate plan tailored to your objectives, giving you confidence in the future of your estate. This morning, we will give you some insights and basics about irrevocable trusts, how they can be used as part of your estate plan, how to use them during your lifetime, and what happens to them when you pass. Emily's going to join us. Thanks, Emily.
Thank you for that introduction, Andrea. As Andrea mentioned, my name is Emily Blackburn. And to get started today, I just first want to touch on kind of the basic types of trusts. And if you joined us for our last webinar on revocable trusts, this slide will look familiar to you. Basically, when we talk about the nature of trusts, we are addressing revocable trusts versus irrevocable trusts. Revocable trusts, if you recall, you have the ability to modify. You can fully revoke them, which means cancel them completely. But irrevocable trusts typically cannot be modified except for under certain limited circumstances. In the state of Minnesota, you can petition the probate court to modify a trust for various reasons, and the court can, approve that modification. There's also a vehicle known as a non-judicial settlement agreement that Minnesota allows, where you don't have to go to court and petition the probate court to approve it, but you can craft an agreement between all of the interested parties in the trust to, modify that agreement to, allow for various changes. Those aren't necessarily, fully binding in the sense that they can be challenged still through the court proceeding. But there are some avenues, as I mentioned, to modify an irrevocable trust. But for purposes of this discussion, the thing I want you to keep in mind is that generally irrevocable trusts cannot be modified. What determines whether something is, revocable or not is the trust agreement and the provisions within that trust, which are governed by state law. And so depending on where it was drafted, that agreement is going to be kind of what determines those factors in relation to a revocable or irrevocable trust. So if you want to, yep, perfect. If you go to the next slide. So today I just want to touch on some of the general purposes that people use irrevocable trusts for in relation to their estate plan. I'm sure you've heard kind of trusts thrown around in relation to all sorts of circumstances. And there really are a variety of things that they can address. You can draft a trust to be as complex or to, cover as many circumstances really as you want, as long as it is in line with state law, the Internal Revenue Code, if there are certain tax, vehicles you're trying to utilize. So here I've touched on some of the main ones that people often want to hear about. One of the largest ones is estate tax savings. So oftentimes people will use irrevocable trusts in their estate plans in order to take some assets out of their estate for estate tax purposes, so that they can, maybe pass on more assets to beneficiaries or whomever they wish, without that value being included in their estate. An irrevocable trust allows them to do that because of the, lack of control of the assets, things like that Andrea will touch on more later on in the presentation. Another common reason to use an irrevocable trust would be asset protection. Again, this is something we touched on in our last webinar on revocable trusts, in the sense that revocable trusts, by their very nature of being revocable, really don't provide a lot of asset protection. It's kind of treated that the grantor and the revocable trust are the same entity for really tax purposes, kind of control of the assets and things like that. So it doesn't necessarily provide that level of asset protection that some people are looking for in relation to keeping assets from the hands of creditors, various entities related to government benefits. That's one of the next reasons on the slide here, keeping the home protected from medical assistance types of programs, things like that. That's when an irrevocable trust can come into play and help with some of those asset protection strategies. Another reason is related to charitable giving. There are trust structures that are irrevocable in nature that will allow for giving to charity, getting some of those assets again out of your estate, and just provide, possibly support for a beneficiary as well, depending on the type of structure that is chosen in relation to that estate plan. So again, all kinds of reasons that a person may wish to set up an irrevocable trust. And it's really important to just make sure you're having those conversations with your advisors as to what circumstances could benefit you. Every trust is very fact-based. It's not a one-size-fits-all. And so, what may work for your neighbor and may be a great idea for them may not be the best call for you. And so we often hear that thrown around from clients that, oh, well, this person thinks I should have a trust. Why don't I have one? And, the case may be that it's not going to work in your favor, or it doesn't really accomplish what you're hoping to do with your estate plan. So it's important to keep all of those things in mind as we go through some of the various topics here today. I will leave it to you now, Andrea.
Thanks, Emily. So planning considerations. So what types of assets are good candidates for an irrevocable trust? Well, the easy one is cash. It has no negative tax consequences. It's readily available in many instances, and provides an easy transfer. Beyond that, you will possibly, or you may have heard about an irrevocable life insurance trust, shorthand referred to as an ILIT. And what that does is it is funded with life insurance. The beauty of that structure is that it, first of all, is outside of your estate, funded correctly and managed correctly. It is absolutely outside of your estate. It will benefit those who survive you, and it could give them a stream of income to pay estate taxes. Particularly if you're in a business or if you have a big estate that's illiquid, that life insurance could give them the ability to pay your estate taxes without having to liquidate something unnecessarily. Another item that's a good candidate for irrevocable trust structure is your residence. Your personal residence can be structured in such a way that it's set up for a term that you have the ability to live there during your lifetime, and it's got a whole bunch of good features. So one of the things is when you transfer that property into that irrevocable trust, instead of transferring it at the full market value, you get to discount that value based upon what the remainder interest will be after the term of the trust is run. So if you fund it at, let's say, 75 years old, and you have a life expectancy of 12 years, the value of that gift is reduced by the amount of time that you'll live in that residence. And that's one of the beauties of structuring it that way. The other advantage is, while you're living there, you're still responsible to pay for the costs of the residence, and it's structured in such a way that you're still responsible for it. You just don't own it any longer. It would be owned by the trust. Another advantage is that if you outlive the term of the trust, then you would start paying rent to the subsequent owners, which typically are children. And that is another way of removing assets from your estate and getting money to them in the form of rent. A third item that's a really good candidate for funding a trust is stock, bonds, and mutual funds. A grantor retained annuity trust can be funded with highly appreciated assets. The advantage here is that the cash is being removed from the grantor's estate. I'm sorry, I misspoke. The advantage is that you're removing that asset from your estate, possibly being able to sell it within that irrevocable trust while you're alive, and you maybe are going to be paying the taxes on it, which I will get into in a minute. So, life circumstances in relation to trust assets. Things to consider: does the grantor need an income stream? How much access should the beneficiaries have? Do you want to provide for a child or beneficiary who has special needs? So with a grantor needing an income stream, maybe, like I said, you're going to fund the trust with those highly appreciated assets, but you're going to structure the trust in such a way that you're going to have an annuity being paid out to the grantor. So what happens is the highly appreciated asset is put into that trust. It's possibly sold within that trust, and then the grantor actually pays the income taxes on it. Through the form of an annuity and the income and consequences of having capital gains. So the grantor in that case is taxed on all of the income earned by the grat, including the capital gains. Secondly, how much access should the beneficiaries have? Well, the terms of the trust document are the determining factor on how much access the beneficiaries have to the trust assets and the income generated by the trust. With a life insurance trust, for planning purposes, a life insurance trust is a good way to utilize your annual exclusion for gift tax purposes, because you're funding money into that trust, and the terms of the trust have to allow the beneficiaries to access any of those funds for a specified period of time, and then and they're notified of that contribution. Once that period of time has run and they maybe haven't acted on accessing that money, the money that's been put in there is available to pay the premiums on the life insurance. The last item of what life circumstances would be: if you have a child or beneficiary who has special needs, those trusts have specific structures, and you should work closely with an attorney who understands what that structure needs to look like and the limitations on that beneficiary having access to the funds. Another planning consideration is for tax purposes. Is it a grantor or non-grantor status? And how does that affect your taxes? So for planning purposes, it's really important to know who will be taxed on the income generated by the trust. As I said, the grantor or the trust could be the person who pays the taxes. Additionally, a beneficiary could be responsible for that. Keep in mind that the income tax to the trust is taxed at a much steeper rate than income tax to individuals. In 2022, the highest tax bracket of 37% starts when income exceeds $13,450 in a trust. So why would the grantor be, you might ask, why would the grantor be taxed if it's an irrevocable trust? That means that they don't have the ability to, as Emily mentioned, they don't have the ability to modify the trust without court proceeding. So why would they be taxed? Well, there's, again, we always go back to the trust document. There's specific language. There's code sections within the Internal Revenue Code that allow certain actions to be taken, and one of them is called an ability to substitute assets. And if you have that language in your trust document, what it basically means is you have an asset worth one value, let's say 100,000, and you want to remove that from the trust and put in a different asset worth the same value. That ability reverts it back to a grantor type trust that's irrevocable. So the income on it is taxed to the grantor, but the grantor doesn't receive benefits from it necessarily. Let's see. So non-grantor type trust would be that life insurance trust that I mentioned. The life insurance trust is structured in such a way that the grantor does not have a connection to it during their lifetime. Any taxable activity is reported and taxes are paid by the trust, but most often the life insurance policy is the only asset of this type of trust, and therefore does not generate any income during the life of the grantor. So moving on, trust administration, control of assets. So when you, the grantor, transfer your assets to the irrevocable trust, you relinquish control of those assets. The assets are now legally owned by the trust, and since the trust property is no longer yours, it will have no bearing on the value of your estate. Additionally, since the assets are not owned by the trust, you cannot be asked or forced to use them if a lawsuit is set against you because you no longer own them. Unlike a revocable trust, once an irrevocable trust is funded, the terms of it cannot be easily changed. As Emily mentioned, it takes a court proceeding, and in most instances, it would require permission from all the beneficiaries to make those changes and or dissolve the trust. So distributions to beneficiaries, asset management. Again, back to the trust document, distributions to the beneficiaries and asset management is the responsibility of the trustee and must be done in accordance with the trust agreement. The agreement may specify an income beneficiary. That person is to receive the income from the trust during their lifetime. The agreement may direct the manner in which distributions of principal occur, and they also may direct the payment of expenses in a specific manner. Anything that's silent in the agreement about any of those items would be handled through state law in which the document was drafted. So if you're in Minnesota and your document is drafted under the laws of Minnesota, Statute 501C follows a modified version of the Uniform Income and Principal Act. What that means is if we have an issue with the trust, it's silent as to, let's say, how capital gains are treated for distribution purposes. We would refer to the Principal and Income Act, the Uniform Principal and Income Act, to determine how the trustee has to handle those and is required to handle them under state law. The last item under irrevocable trust administration is gift tax returns. So in 2022, gifts of up to $16,000 annually can be given to a particular individual without gift or estate ramifications. This is referred to as the annual exclusion amount. Gifts to a trust are not, unfortunately, gifts to an individual. So careful planning must be done to allow for the annual exclusion to be utilized. I previously mentioned something called a crummy power, and that's the item that needs to be present in a trust document in order for the annual exclusion amount to be utilized on a gift tax return, and those named individuals. So if you have a trust that has, well, I have a trust that I work on that has 70 beneficiaries. So you would be able to do 16,000 times 70 for funding, and utilizing those crummy rights, you wouldn't have any issues until you exceeded that amount, provided that the correct procedures were followed in notifying the beneficiaries and allowing them and giving them the required amount of time to act on that crummy notice. As with everything, the governing document must include language to allow for this action. That's all I have for today. Emily, do you have anything to add before I wrap up?
I think one of the important distinctions, from some of what Andrea touched on related to grantor or non-grantor trust status, is that many of these trust structures can be either one. So it's not necessarily, it has to be a grantor trust or it has to be a non-grantor trust. And that's just something we want to make sure we really highlight, because there are, again, many ways to structure these trusts. Certain ones, are structured in a certain manner if you're trying to, for example, meet IRS guidelines. But it's just important to make sure you're meeting with your attorney, advisors, and really going over what your goals are and also what the assets are that could potentially be put into some of these trust vehicles to meet those goals. It's not a one size fits all, as we mentioned. There's many types of trusts, and it can get confusing. And we've touched on some of the basics here today, but there are obviously a lot more complex issues related to this. So it's definitely important to make sure you're getting in touch with your advisors who know what they're doing. And so if anybody has questions, we will certainly stick around and try to answer any questions as best as we can for you.
Emily, I'll ask the question and you can answer it. No. Is there a lifetime exclusion to transfer funds to kids or a trust?
A lifetime exclusion. So there's a lifetime exemption amount, yes. And right now I think it's 12.06, I believe, yep. Million per person. And that's at the federal level, that you can gift away to anyone without incurring gift or estate tax. Now, it's important to know that it's a unified credit. So if you use that all up during life, there's nothing left to use at your death. But for many people, that is plenty to be able to pass on assets to their loved ones without incurring any gift or estate tax. Andrea mentioned crummy rights. So you have the annual exclusion. Should gifts go above that annual exclusion, that's when that exemption amount is triggered. And so you still may not have any tax due. You'll just be eating up some of your lifetime exemption amount.
And it's important to remember that when you are doing annual gifts, that when you do go over that 16,000 amount, that's when you are, like Emily said, you're triggering a gift exclusion utilization, but you also are triggering the requirement to file a gift tax return. And federal and Minnesota laws differ on gifts. So Minnesota allows gifts to be made. You don't have to file anything in Minnesota, but they have a 3-year look back. So if you give a gift today and you live 3 years, that gift is no longer includable in your Minnesota estate. So in some instances, we're planning for Minnesota estate purposes because their estate isn't as large as a federal exclusion amount. So Emily, this is directed to me. So can you explain again how a primary residence that is put in a trust is valued either at the time of death or the lifetime of the contributor? Do you want to answer or do you want me to answer it?
I can answer either way, doesn't matter. So as Andrea kind of mentioned, when you are transferring a primary residence into a trust, the specific trust she was talking about was a qualified personal residence trust. And again, there are certain provisions that have to be in that trust agreement to make it qualify as such. When a residence is transferred into this type of trust structure, we file a gift tax return. The value of the home, typically there's an appraisal done. We take that value, it gets discounted basically in relation to the grantor's life expectancy and the term, the amount of time that they're going to be able to live in that home. And so you get to take a chunk of that basically out of the value of that gift. Now, if that grantor does not survive that term, that QPERT term, then that residence gets pulled back into their estate for estate tax purposes. And then that value is basically on their date of death. It gets valued at that and included in their estate. So, if a QPERT is a consideration, we don't necessarily want to be using this type of trust when we have an elderly client, who we have a term of 10 years, but maybe their life expectancy is only going to be 3 years or something like that, because we know that they, in all likelihood, won't survive that QPERT term. And then we're kind of negating the whole purpose of why we drafted that trust in the first place. So again, very fact-based scenario, and should be consulted with CPA, attorney, all of those people to make sure that it's structured and reported the right way.
And if that grantor does outlive the term of the trust, mm-hmm. then they, if they continue to live in the residence, then if the children, for instance, are the beneficiaries, mm-hmm. they would begin paying rent to the children based on a fair market value. So that is also a consideration. But there's a whole list of guidelines of things that you have to meet in order for it to qualify as a qualified personal residence trust.
I can read the next one.
Okay.
When your spouse dies and the revocable trust becomes irrevocable, what does that mean? So I'm assuming this question is kind of related to the webinar we had initially last month with revocable trusts. Basically, if someone has a revocable trust, upon their death, it becomes irrevocable automatically, meaning they don't have the authority to change it. It can't be modified anymore. Beneficiaries can't come in and say, hey, I want to change this. Whatever is listed in that revocable trust agreement, as of the date of that person's death, becomes irrevocable, and the trustee now has to carry out the terms of the trust according to the provisions listed in there. So typically there's a paragraph in there that, is related to administration during life, and then there'll be administration at death. And the trustee just has to follow the instructions in that trust agreement. And that's what that means when we say it becomes irrevocable upon death.
And just a side note, sometimes you can have some confusion because when you have an estate that you're administering, oftentimes the initial trust that is set up from this person passing is still called the Jane Doe Revocable Trust. Mm-hmm. And even though it's called a revocable trust. It's an estate administration trust and is used solely for the purpose of administering Jane Doe's estate. And once her estate has been fully administered and the assets have been distributed according to the terms of the document, typically that trust does not remain in existence any longer. Other trusts either come out of it or the assets have been fully distributed. Is there a clawback time frame, federal, state? For certain items, yes. For Minnesota purposes, there's a look back. I don't know that it's necessary. Well, I guess it's a clawback. So for Minnesota purposes, if you make a gift within 3 years of death, that asset gets pulled back. Those assets get pulled back into your estate for Minnesota purposes, but not for federal purposes. For federal purposes, you may or may not be aware that the exclusion amount, the 12.06 million that Emily mentioned, is set to sunset on December 31st, 2025. And when that sunset occurs, the law as it currently exists ceases, and it reverts back to the law that was in existence, I think, in 2017. The IRS has formally stated that there will not be a clawback. So if you do gifts right now that utilize that full exemption amount, that exclusion amount, there won't be a clawback to add that back to your estate at this time or in the future.
And one note I just want to add to that is, I think you mentioned it earlier in the presentation, Andrea, but I just want to clarify again that the Minnesota clawback, it's for taxable gifts. So if you're making those annual exclusion gifts, that's fine.
Absolutely.
Those will not be pulled back in for Minnesota purposes. It's just anything above that amount would get pulled back in your estate's value for Minnesota estate tax purposes.
Mark asks, what is the 12.06 million scheduled to be reduced to as of 12/31/25?
It's 5 million indexed for inflation. So,
Yes.
you know, whatever amount they adjust that to, and inflation is obviously.
If it were to revert back right now, I would guess it's going to be somewhere around 6 million.
Yeah.
Just half of what it currently is. Because they doubled it back in 2018. Does anybody else have any other questions? Any other comments? No, I don't see anything else coming up. We want to thank you for joining us today and hope you got some nuggets out of the information we provided. If you'd like assistance determining the best plan for your specific situation, we are here to help. As a reminder, the session was recorded and a link will be sent out to each of you in the next couple of days. Our third session in the Anatomy of the Trust series will be on June 7th, covering charitable trusts. Thank you so much for your time today. We appreciate it.